My name is Sean Delaney.
I'm Andrew Grunler.
Jason Gregerson.
I'm Nolan Hill.
I'm Ryan Lindstrom.
And without further ado, let's take a look at our valuations.
So for Whirlpool Corporation, we've decided to issue a hold recommendation. We set a target price of $188.10. At the time of the analysis, the current price of the equity was $184.77, giving us a premium of 1.8%. This recommendation is based on Whirlpool's great global position and market share, meeting headwinds from growth opportunities abroad, strengthening dollar, and a struggling price mix. Let's take a look at some of our valuation models.
So shown here are our dividend discount model valuations. We did use a 2% long-term sustainable growth rate. Note that Whirlpool's 5-year dividend growth was right around 15%. So we did deviate away from that a little bit for a couple of reasons. First, we thought that
Concerns about retained earnings.
we figured that Whirlpool was going to increase the retained earnings. Second, we thought that they are already yielding right around 2.3%, and the industry average is right around 2%. So now we'll take a look at our free cash flow models. Here we have done calculations for free cash flow per firm and free cash flow equity using the Gordon growth model, the two-stage basic model, and the two-stage H model. We did use a 9.5% weighted average cost of capital to discount our free cash flow to the firm, a 9.83% cost of equity for free cash flow equity, and again we used a 2% long-term sustainable growth rate. So, taking these into consideration, we calculated our target price, and in doing that, we took the average of the 3 free cash flow to the firm valuations and came up with a target price of $188.10. We used free cash flow to the firm because we thought that it better represented Whirlpool's ability to generate free cash flow. Now that we've taken a look at this, let's take a look at our SWOT analysis.
One of Whirlpool's greatest strengths is its size. It is the largest consumer appliance company in the world, and it has a 26% market share in the U.S. However, since 53% of its revenue comes from the North American market, they're looking to expand globally for their growth, especially in a place like China. However, they've been doing this through a large part of the way they've been doing this is through acquisitions. However, with acquisitions comes the risk of not properly integrating them and not creating synergy within the company that could be detrimental to the company's earnings. Now let's take a closer look at these acquisitions.
During 2014, Whirlpool made 2 major acquisitions. One was Indesit, and the other was Hefei Sanyo. Hefei Sanyo making up roughly 6% of the Chinese region. We believe that Whirlpool was trying to expand their global footprint by targeting pre-established firms that met these 3 main criteria of product, brand, and technology. Although Whirlpool's expansion and acquisitions generally try to raise revenues and sales, this doesn't necessarily correlate with the same growth rate in earnings. This is due to the fact that acquisitions in foreign countries have exposures to synergy risk as well as various regional risk. Taking a look at where we are heading, let's take a look at our revenue breakdown.
So looking at our revenue sources, starting on the right here, we can see that Whirlpool clearly has a well-diversified product segmentation mix. But it's important to note on the left that, as we've heard earlier, 53% of Whirlpool's revenues come from North America. As Whirlpool continues to look globally for growth opportunities, the firm seeks to globally diversify its revenue streams, and it's important to keep that in mind as we take a look at our individual region analysis.
All right, so before we look at each individual region, I want to stress that there's 2 main themes in a lot of these regions. One, negative impact of currency. Whether that's due to a general strengthening dollar or specific weakness in certain currencies, that's going to be a big theme. The other big thing is going to be deterioration in price mix. So in other words, more of their sales coming from lower end products instead of higher end products, then that's going to shrink margins. Okay, so looking at North America specifically, we have Whirlpool's guidance up here, as you can see. As you can also see, we look at their guidance as an overestimate. So why is it an overestimate? We have some factors here that are going to be headwinds to operating margins. So we'll start with competitors. Now, while Whirlpool always has strong competitors they have to compete with, specifically last year, they had a problem with one of their competitors, Samsung, illegally dumping high-end products at a discounted rate into the North American region. And so this really hurt their pricing mix. Now, you might look at it as a one-off event, something not to look forward with. However, this isn't the first time that Samsung's done this. We don't expect it to be the last time either. So it could still be a headwind moving forward. A bigger risk, however, is related to currency. Last year, they had a $20 million loss due to the devaluation of the Mexican peso. So they tried to offset this by raising prices. But you raise prices, then you potentially hurt demand, and also, once again, drive consumers to the low-end product, hurting price mix. So we also look at that as an ongoing event. If you look at our current relationship, our new administrations, the dialogue with Mexico, we believe that could be the new normal of the weakening peso versus the dollar, and so we could see that continue. Now, the net result is that in the last year, Whirlpool went from a 12.6% margin in this region to 11.1%. We believe that trend is going to continue and not reverse like what Whirlpool is guiding. So what about industrial? They have expectations of 4 to 6% here, and that's primarily led by two things: strong growth of the U.S. economy and also the U.S. housing market. And while we've certainly seen a boost in the U.S. economy since the crash of 2008, we've seen that growth. We've seen unemployment go from 20% down to something like 5%. We haven't seen the same kind of growth in important metrics like real wage growth. So historically, real wage growth could be around 6%-ish. Last year, we were doing 3.6%. So if we don't have that firm base, we might not get the growth in the economy that we're hoping for here. The other thing is housing, of course. We look at the next slide. Why is housing so important? We look at housing starts. Every new home comes with 4.1 new appliances. So this is clearly a key metric here. What we have in this chart is indicating that while we are below the historical long-term average here, we can see right at the end here that our trend is starting to flatten a little bit. And we have had the strong growth from the crash to current. Once again, if that's not based on metrics like real wage growth, we feel this could flatten more than accelerate, and once again, slow revenue projections in this market. Okay, so the big idea here is this is their biggest market, and we believe revenue is going to be less than expected here. All right, moving forward into EMEA, so Europe, Middle East, and Africa, really more of the same here. We're going to see margins last year going from 5.6 down to 3.3%, so a negative trend. Why negative? Currency being the primary driver. They lost 40 million due to Brexit-related problems. And once again, we see that continuing as they continue on with the Brexit move. Other issues: slow growth economy in Europe. This is driving people once again to those lower products, hurting that price mix. We believe that's going to continue. Now, what about growth? Whirlpool's hoping to offset this by growth in Russia. That's one of their drivers, as well as growth from their new acquisition of Indeset. But if you're counting on Russia for growth, you have to be concerned about the price of oil, as their economy is very much tied to oil. So what do we see with oil? It's high rig counts, strong supply. I don't see oil breaking out of that range, and therefore we don't see Russia's economy necessarily taking off. So if you downplay Russia's economy growth, that's going to lead to lower than expected revenues in this region. And this region counts as 25% of Whirlpool's overall revenue. If we look at some of the other regions, Latin America, this is the wild card region. This is hard to predict. Most of this is coming from Brazil. It represents 15% of Whirlpool's total revenue. And it's hard to predict because Brazil's currency fluctuates. And it's not very predictable. Also, they have trouble with raw material costs. And you can't really hedge those in the Brazilian market. So whereas here you might be able to do some option trading or some futures trading to hedge your risk, you can't really do that in Brazil. And so Whirlpool just has to kind of flow with that. So because of that, we're pretty much keeping our guidance in line with Whirlpool's in this region. Moving forward to the Asia region. This is their growth region. We have strong growth in India, so there's demand potential there, and also China as they made that acquisition. So we see growth potential in this region. Now, growth comes at a cost, so we could see a deterioration in operating margin. So that's definitely a risk here. And the bottom line is, even though we see growth in this region that might offset some of our key risks here, it still only represents 7% of Whirlpool's total revenue. So this growth isn't going to offset the other weakness. So the primary result of all this region breakdown is if you look at their two major regions, we're expecting less than expected revenue in those two biggest regions. And that ultimately led to our less than expected revenue growth and also our recommendation of hold. So in conclusion,
we recommended a hold recommendation, strengthening dollar, currency risk, operating margins being lower because of the price mix. At this time, we'd like to thank you for having us and entertain any questions you might have.
You guys did a really good job kind of looking at the competitive landscape as well as just factors within the business. Taking a step back, if you were going to place yourself in the shoes of the CFO, what would you do to maybe increase earnings or compress margins to really increase that valuation going forward over the next 5 years?
I think they have a strong strategy. They are looking for growth in the right areas. These acquisitions are going to be accretive. They are going to be good acquisitions. But the biggest thing is they don't hedge their currency. And so, given the long-term trend that I think that a lot of people look at, they should really be a little more aggressive in those hedging practices.
I like the conviction on, you mentioned, hey, our model is a little lower than their guidance. And, to make money in the market, you have to figure out where you're different from where the market stands. That part's good. Just wanted to drill down a little bit, though, on how you're looking at their 2017 guidance. I don't think they go very much farther than that, but they give some long range. But maybe elaborate a little bit more on how accurate they've been in the past, why you differ so much from what their guidance is.
Well, it's really hard to kind of compare what they've done in the past because they were a pretty steadfast company up until 2011. That's really when they started to look at global expansion. So they've seen a lot of volatility since then. And also looking at their two major acquisitions is just going to throw off a lot of their historical data. So it's hard to look back and say, here's their historical revenue and this is what they've guided on, their plus or minus there, because of this kind of big change in their company. And so what we've looked at, as far as looking at 2017 and onward, is that our big trends are currency, and this is a longer term trend, so this isn't just 2017. So I think we can kind of project that out moving forward. That's going to be a headwind for the next 4 or 5 years. Also things like the U.S. housing market, we're talking about a rising interest rate environment being a headwind to that. Once again, this should be a long-term trend. And so a lot of our key pieces of our thesis are really can project not just 2017, but much farther out. Does this answer the question?
Yeah, absolutely. So I think one of the things Whirlpool would tell you is, yeah, they're guiding to a modest revenue. You're a little less. So that's not a big difference. They'll probably tell you that they can continue to get operating leverage and better margins. So what are the elements of margin and operating leverage that they're looking at that you're maybe not as high on?
I think we looked a lot at supply chain. So then again, thinking globally, a lot of the materials actually come from Brazil and places where currency risk is a large factor. So as those currencies continue to fluctuate, we kind of as a team cast a little bit of doubt on the, supply chain risk when it came to pricing. So obviously, if they're paying too much for steel, tin, copper, their margins will decrease as well if they don't operate more efficiently in the manufacturing.
Can we talk back to your valuation? Can we talk a little bit more about the growth rates? Where did you guys derive your kind of high and low end there, the 2 and 5% from?
So the primary value for our long-term growth rate was based on the revenue trends. So we looked at some of the historical revenue, said that's going to be about 3-ish% is what we forecasted out, and we basically pared that down based on our risk operating margin.
Can you give me some more detail then? The free cash flow numbers that you have up there are for 2017. Is that where we're pulling those from?
The free cash flow evaluations.
Yeah, and your parameters on the left side there. Got $1.1 billion and $1.05 billion.
I think they're for 2017.
Okay, because that's about right for 2017. And then in the two-stage model, so you're doing describe the two-stage model to us in a little more detail.
The two-stage model gives it a high growth rate, and then it kind of drops off to the perpetuity growth rate to push all of those cash flows into the future and discount back. We did the two-stage basic and two-stage age model because the age model kind of tapers down slowly, whereas the two-stage basic goes straight from 5 to 2 into perpetuity. So it usually it's less of a drastic change.
So as we've seen revenue spikes recently that maybe left with a higher percent, we don't think that individual high revenue growth rate is going to be sustainable, and so we look at the long-term growth rate and we just taper down to that.
Okay, so you've got the high growth rate going extrapolated out for how many years here?
Just 1 year.
Just one, and then you go to the
And then
perpetuity.
2%
Okay.
perpetuity.
What would happen if you looked at maybe a enterprise value to EBITDA exit multiple 5 years out? So, you know, if you're doing two-stage and say, let's eliminate the perpetuity, and what's it worth 5 years from now based on maybe a PE multiple or a EV to EBITDA multiple?
You know, we really looked at trying to do those relative evaluation metrics. The problem is finding a good comp. I mean, because if you look at their competitors, a lot of them are big conglomerates, so you can't really compare them to Samsung because it's such a broad mix of things. You can't really compare them to GE. And you look at some of the smaller players, and a lot of them are focused in specific regions in international markets. So it's hard to find a true comp where we can really compare those PEs and compare those ratios. So that was the problem we ran into there.
Okay.
Is there any other target acquisitions that you maybe thought would be a good place to spend some of the extra cash flow that's being generated going forward?
Hard to predict would be the first thing, and then I think that they're going to be good for a little while here. They're certainly going to want to boost that, but you know they're a group who spends a lot of time in their acquisition. If you look at the acquisition in the set, they were in communication with that company for a long time moving forward. It's really kind of a chance that both these acquisitions happen in just a short time frame. They've been working with that family-owned company for a long time before that purchase actually went through. So they're not going to rush into any acquisitions. And that purchase of Hefei Sanyo was really a major purchase to give them that foothold. They're a pretty well established company. So I think the focus will be growth for a while, and then once again building up those retained earnings to maybe look forward farther out.
Sure.
If you had you had a blank slate, you're now in charge of the company. I've tasked you with re-engineering their balance sheet. Do you like their balance sheet? Do you like the leverage characteristics? What would you do from that kind of a capital engineering to engineer the balance sheet, put it where you want to? What would you do? Next 5 years, you've got $5-6 billion of free cash flow to do what you want with. How are you allocating that?
I think we're delevering. I mean, I think the idea is they've built up a lot of that debt based on these acquisitions. You know, they're targeted, they're there for a reason, they're there for the growth, but they have, you know, left a relatively high debt to equity ratio. And so we want to kind of pare that back, you know, especially given the fact that we're going to be looking at rising rates. So they want to kind of pare that down and stretch some of that debt out to be a better well positioned. So I think that would be my primary focus.
What's their market share in China?
It's about 6% with the Hefei Sanyo purchase.
Okay, so how do they benefit if they can get up to critical mass, and how do they walk it up?
Depends on all those margins stay while they go through that growth. So if they're going to do a lot of spending to grow that company in that process, you're not going to generate a lot of extra free cash flow in that growth stage. And hopefully they build up to that, you know, 26% like they have in the U.S. Position in China. They get to that level, then they can start trimming back those margins, and then you see the benefit. But it's going to be a ways out as they continue to spend money to grow.
How much weight do you put on the quality of management, and how do you assess the quality of management? What's your view on whether Whirlpool is well run?
There's a lot of ways you can kind of look to that value. So as a group, our decision really look say, is it a problem? And we don't view that as a problem at all. They have strong management over some period of time. And so we don't look at it as primary as a risk. Now, do we add that in as a gain? Not necessarily. We feel these other drivers offset that. It's not a headwind or a risk that we're going to worry about.
What's that? You did a dividend discount model, which I like. We haven't seen that today. What are the benefits and the limitations of the dividend discount model?
Well, the dividend discount model is highly sensitive to growth rates. Obviously, you can change growth rate by just a few percent. You get a crazy valuation compared to other one. But I think for Whirlpool, it's not the greatest fit because they have grown dividends so much in recent years. So that growth rate is kind of sensitive in that formula. Also, they are still expanding and growing, and they haven't really grown their dividends with their revenue in the last 4 or 5 years. But we do expect that to begin occurring in the future.
Beautiful model for Whirlpool 5 years ago, 10 years ago, where they have this long history of a stable dividend and stable growth. Now they're into growth territory, and so now that dividend growth model is less applicable.
Time. Thanks. Thanks, we like the full team. Good job.
Thank you.
Thank you.
Thank you very much for inviting us.